Yeah, what we're going over is the leading economic indicators, mainly industrial production, the purchasing managers index, durable goods orders, and the unemployment rate. And now we're getting into inflation and how that can be a leading economic indicator as well. Inflation tends to peak right before a recession as well. Deflation is more dangerous than inflation, contrary to what you may have heard. I don't know what people. I was just because my parents were like they remember a time when in the late 70s and early 80s where it seemed like your salary was staying the same, but every week you were paying more and more for goods, and so inflation to them is like a real and scary thing. Now inflation has averaged like 2% per year for a long time. I mean, I've never really worried about inflation. It's not been a factor, but it will tend to creep up around like 4 or 5% per year, like annually, right before recession, or at least that's what one of the averages is. So headline inflation, where do you see prices most often? I mean, it's at a gas station, right? You drive down all the time. So your idea of inflation may be pegged to that. It also, like I said, may be pegged to groceries. But core inflation, that's the red line. That's taking energy and food prices out, which you can see is a lot more stable. Food prices can depend on crops. Was there a bad harvest? Did something happen? It could be weather related. Oil prices, obviously. That can depend on a war in the Middle East or something like that. But core inflation is a lot more stable, and you can see the overall trend with that. You can see, okay, so during the early part of recovery going down. Early part of recovery going down. Starting to come back up there. But yeah, so we're still seeing it. It really should be going up. It should the red line should continue to go up, but the main reason that it hasn't has been oil. Oil is almost single-handedly dragging inflation down. So again, not used by the National Bureau of Economic Research to date cycles, so it's not. Again, it's nowhere near as important or as reliable as unemployment rate. So the consumer price index, you can see this is like a basket of goods. This is the rough breakdown of percentage of what people spend their money on. Housing being the biggest part of that. Okay, 41.4%. That makes me feel a little bit better because I don't spend nearly that much on my rent. But if you are a homeowner, your mortgage may be fairly high. That also, I think, includes your your upkeep on that as well. So that's how those components are weighted, and so it gives you sort of an idea of how important those sectors are. You can see inflation is going down over the long-term trend. And again, headline inflation as of 2015. That's that's mostly because of oil. The core inflation is at 1.8%. The Fed really 2% inflation is considered healthy. They're trying to get up to that. Inflation is it sort of means that there's liquidity is improving. The money supply is increasing. That's a very good thing. When there's a lack of money supply, when you have deflation, then you don't want to spend your money because you think that it might be worth more in the future. So that means that nobody spends money, the markets don't move, businesses aren't making money because they're not selling anything, and the whole economy stagnates. So that's why deflation is very, very bad. Japan has been in deflation for a long time, and it's really hurt their economy. And so deflation is much scarier to the Fed. That's part of the reason that they wanted to raise the federal funds rate, because that will help boost inflation a little bit. CPI and PPI, bless you. This is consumer price index and producer price index. Producer price index, that's corn, oil, again, commodities. This volatility is part of the reason that derivatives are so popular. You can sell futures. If you're if you're growing corn or if you're growing a lot, or creating a lot of a commodity and you don't know how much it's going to sell for next year, you can sell futures on that. There's an agreement with, say, you're an oil producer. Delta Airlines says, hey, we'll buy your oil at this price next year. And you're like, okay, good. At least I've got that in the bank. I know I can sell it at this price. And it's a hedge against volatility. Let me skip here to, consumer confidence is important. So consumer confidence, and Dr. Holzhauer can tell you all about this because he's teaching behavioral finance. This is a psychological component. A lot of this comes from people, like how are they themselves doing? Did they get a new job? Did they get a raise this year? Do they see that they're paying less for gas? How do they feel like economic conditions are going? And by the way, I meant to talk about this earlier, but part of the reason that we study this is because we don't want to get our news from the news. We don't want to get our news from television programs or anything, because their whole purpose for existing is to sell ad space, to keep you watching. And would you ever watch any of these programs if you turned them on and they said, everything's fine, you don't have to worry, it's okay? So every time you turn, even Bloomberg, something more reliable than that, than say, sort of like, pop news like Fox News or CNN, they're still gonna try to like bait you by saying like, we could be on the verge of something really bad, could be really bad news coming, better watch, stay tuned, so you can't overreact to what you see on TV or what you see on, you always got to consider the source. There's a guy, I always see him quoted, his name is Bill Gross, he works for PIMCO, and he is always saying that the sky is falling, we're at the peak of the market, get out now, buy bonds. Well, what does he do? PIMCO he sells bonds. So he's got a vested interest in telling people to get out of stocks and buy bonds. So anytime you see, Bill Gross says, now, I've been watching this guy for the last 3 years. He says the same thing every time. So, or when you see like on Yahoo Finance or something, they'll say sponsored content, throw it out, So always look at like, what is this person's reason for saying this? Jim Cramer is the opposite of an alarmist. He wants you, he's going to be more bullish often than not because he wants you to watch his program the next day and say, how can we make money? How can we make, there's always a bull market somewhere. So, some people want to make friends, I just want to make you money. That's how he's going to get you to watch the next day. So we want to look at things like consumer confidence. Unfortunately, consumers are sheep. So, but it really, because consumer spending is such a big chunk of GDP, it really matters. Housing is number 2 is housing. That's huge. That's one of the most reliable things you can look at for GDP growth. And housing is still good. I have friends who build houses, and they're like it's been a huge boom for them the past couple of years. They're still doing a lot of home building for people who are building second homes. If wealthy people are building second homes, that's also really a good indicator for the economy. Then you've got retail. We're having to track things like Amazon more and more. Online sales are probably still not tracked as well as they should be, but we're getting there. Personal income, spending, and consumption. One thing I saw earlier this year that made me think that people were going to spend a lot more money over the winter holiday retail season was that consumers were adding more debt. Okay, so they were beginning to take on more debt. They were starting to add higher balances to their credit cards. That can be a sign of desperation, when people are running out of money. But it's also, especially at this time in a business cycle, it's generally a sign of confidence. It means I'm going to be able to pay this off. I'll go ahead and spring for this. I'll buy my kid a really nice present because I know that 3 months from now I'll still have a job and I'll be able to pay this off. So consumer debt level is something that you can look at as a sort of a leading indicator and also indicator of consumer confidence. But these are done every year. Again, you can find this on Fred, and this is you can track this pretty much with the recession. So you can see it kind of goes up and down, up and down, up and down. A lot of wiggling. That's because people are following headlines generally. So they really are getting a lot of their feelings from the news. For instance, there was one cable news network who in 2012 was saying that we were still in a recession. Now, a recession is when you have contraction in the GDP. We hadn't had contraction in GDP since 2009. So what they meant by recession was just that things are bad, you don't have your job back. But they're counting on the fact that their viewers don't know what a recession actually is. So tragically, again, consumer confidence is not based in reality sometimes. So, all right. Almost done here. So housing, again, one of the most reliable leading indicators. This is because it takes about 3 to 6 months to build a house. So if somebody's going to make that investment, then a house doesn't get built all at once. First, you got to buy the materials. You got to do some hiring. When people build a house, they typically use a lot of subcontractors. So there's a lot of different guys who come in. They do the plumbing. They're going to do the wiring. There's like 40 or 50 people a lot of times that are involved in the building of a house. So each house kind of creates a lot of short-term jobs, and that's why part of the reason that housing is so important. Like it says, large multiplier effects. Again, sensitive to interest rates because why? Because people want to build houses when interest rates are low, and it's cheaper to get the loan. Home construction accounts for about 5% of GDP. That's huge, and so that, along with the multiplier effect, is good. And like I said, best to analyze 3 to 4 month averages because there may be seasonal things based on weather. I know, like a lot of construction tends to stall out, like in the winter, like when it gets really, really cold, or especially if you're in the Northeast and there's a lot of snow. Really hard to do a lot of building then. So you shouldn't overreact to 1 month's numbers for housing construction because it could be weather related. So housing starts, building permits, existing home sales, construction spending, and then the home price index. These are good indicators to watch. And okay, so red line, new one-family homes for sale. These are, again, brand new constructed houses. Now you can see, this is part of the reason that we had such a horrible recession, because this red line is purely speculative. It was believed by a lot of people that, again, the price of houses would never go back down. I heard a lot of people saying that a home is the best investment that you can have. You hold it for a long period of time, it's going to go up in value. A lot of people had more or less their retirements tied up in their homes. And so when they got underwater on their mortgages, it was just had a devastating effect. I know people who bought a new house at the top of the market. I myself narrowly avoided buying a condo in 2008 for $80,000 that was $50,000 2 years later. So I'm really glad I did not do that. But this is, I know people who were not that fortunate and in fact bought much, much more expensive houses that they couldn't unload for half the price later on. So new home sales, this part of the reason that they're not going up as fast as they could is because there's still a lot of inventory from several years ago when a lot of these things were built, especially in states like Florida. Florida got hit really hard by that. Arizona, a lot of like sunny areas. Chattanooga locally did not get hit that hard by that dip because Chattanooga wasn't a great place to live until pretty recently. So you didn't have the same bubble that you had in some parts of the country. So this is a positive trend that we see. So retail sales, a third of consumer spending. We are really hoping for big earnings numbers coming out from say Amazon and other things, like even like retail brick and mortar stores, and that's really going to affect some of our. We are overweighted right now in consumer discretionary because we were trying to ride what was supposed to be a good wave of retail spending over the holidays. So it does include online purchases. But again, it could be better. It is volatile. So you can see that red line. That is retail sales excluding food services. People are spending more money on. Wait, that says the same thing. I think the retail I think the blue one is supposed to include food services. Because yeah, so obviously the red line, people did not stop eating during the recession, but I think that's excluding food services. But you can see just how severely people cut back on their spending, and that in turn, kind of deepened the recession. It has sort of a rollover effect. So what we're wondering here is why are people do seem to be buying less. Now, I think that this is a generational thing. Millennials are being compared very strongly to children of the Great Depression, because millennials, stereotypically anyway, do not care as much about possessions as Gen Xers and baby boomers did. They care more about experiences, concerts, travel, not so much hoarding. Baby boomers tended to be more hoarders. They tended to have a lot more junk. Take it from me as somebody who works in a lot of people's houses. When I'm in older people's homes, many times, doing work for them, cleaning their windows or whatever, I can't understand why they have so much stuff. I cannot relate to it. I'm just like, okay, why do you have this ceramic dwarf? I can't get my mind around it. But millennials tend not to think like that. So I think that is a generational thing. It's very long-term cyclical, but economists are still studying this. This is the St. Louis Fed Financial Stress Index, and this is a, let's see, 0 represents average financial market conditions. This means that there's a lot of liquidity in the market. Those spikes are when everything gets really tight and banks are terrified to make loans. You can see, like, they started to realize, like, uh-oh, we're on the verge of something bad happening here. They started to realize how overextended not only they were, but the average consumer was. They started to smell the credit crisis coming, and then you can see this spike. So now, right now, it seems like a very low stress time for the market. But that would be something to keep an eye on. I think we might see it start to curve upwards pretty soon. So, let me just get through all these. We're at the end here. So again, use common sense. Again, like, these are estimates. Economic indicators can be volatile, must not generally be viewed in isolation. Watch for overall trends. Business cycles do not change on short notice. That's, again, this is the thing that the entire market is sort of freaking out, and why you're seeing it go up and down right now. Is you could make the argument that we're on the verge of a recession. You could. You could also make the argument that, like, now's the time to jump back in. People are overreacting to China. Things aren't as bad over there. Unfortunately, I don't think we understand China well enough to really say exactly what's going on over there. They are not held to the same accounting principles that we are. So there's a push internationally for better accounting principles that are used internationally, but we're just not there yet. So that's part of another reason why we want to stay within American companies, is because every statement of cash flows looks the same. Once you know how to analyze one, you can pretty much analyze the rest, unless they have a weird tax structure like a REIT. But so again, like, don't use daily stock price movements. It's really tempting to follow, like, oh, this has been going up for a month. Let's jump on this. That can't be how you look at it. And Yelena's workshop next week, she'll talk more about fundamental analysis and what numbers within a company you need to look at. Again, forecasters have biases too. Like, get to know some of your favorite and least favorite analysts. Don't listen to media pundits. Dig into reports. Conduct global business cycle analysis. And again, where you feel like you fall short, talk to Perry. But yeah, make economic indicators part of your research and presentation. If you're presenting something on a stock, it would be a really good idea to have 2 or 3 charts from Fred in there, supporting why you think now is a good time to buy this stock. And again, avoid analysis paralysis. Use common sense. I'm gonna jump to this. These are apps in case you really want to nerd out over this stuff. But Fred, if you familiarize yourself with Fred, that would be really good.
All right, let's end real quick. What are your 3 favorite leading indicators? Just real quick, you don't have to even explain, just so that they know what you're looking at real quick when you're trying to get a fix on the economy.
Well, again, this is my bias, so part of my reasons for them being my favorites is because they don't fluctuate a whole lot and they're easy to find. Okay, so the unemployment rate is number 1. I would say ISM is probably, well, hold on. I guess consumer confidence, because but I lean towards consumer discretionary. It's my favorite sector, so that's going to be a favorite of mine. And then probably the ISM, just because, and I think part of my bias towards that is I'd never heard of it until 2 years ago, and then when I found out what it was, I was like, oh my gosh, that's incredibly important, because that sort of balances out my leaning towards consumer discretionary with some hard, industrial production data. So.
All right, finally, the follow-up question. You say this to the officers a lot, but these guys don't go to a lot of officer meetings. What's your viewpoint right now on the economy, and what sectors would you think we should be overweighting towards or underweighting it away from?
Well, again, I would almost like to hedge it in terms of like very conservative sectors right now and more pro-cyclical sectors. So I think energy is toxic for a while. I wish we had not weighted it so highly. And again, we're under 10% on it, so it's not like we were like overweighted, but it should have been closer to percent. Consumer discretionary, I still have faith in. I like our chances for good numbers. Also, we hold Chipotle right now, which is bound to come back. It really couldn't get lower, and it's sort of they will eventually stop poisoning their customers. I'm confident they will do that. But yeah, I think that right now I'd like to see. I'm not as aggressive in terms of like pro-cyclical sectors as I was 6 months ago, but I think as far as the financial sector, if we're in smaller banks, I'd like to do some stuff there. JP Morgan is down for no reason. They did really well on earnings, and for some reason their stock has gone down. So I like financial, I like consumer discretionary, but I also like consumer staples and utilities. I know those are considered like opposites in a way, like one is really conservative, one is aggressive, but I'd kind of like to be overweighted in over conservative and over aggressive right now. Does that make sense?
Yeah. You don't like the average middle law sectors.
I'm not. Well, so IT is really tied up in China right now. Like I'm concerned. Like a lot of our big IT companies. I mean, like Apple, for instance. I mean, they sell a lot of stuff to China, and we're having a hard time getting a handle on that. So that makes me concerned.
Any concerns with healthcare?
It's not my favorite sector. It's not the one I know the most about, unfortunately. But I think that healthcare, as a sector overall, I think it's a good place to be in because, like I said, that's where. Just because inflation goes up the most, the price of healthcare is not going down.
Basic materials, industrials, you thought?
Hate basic materials. Because I would say I'm not a big fan of either one right now, honestly, because industrial again is like tied to global growth. Basic materials, it's hard to find basic materials companies that are in the U.S. We don't produce a lot. You can find them, but basic materials depend on, they're typically produced by these small developing countries, and global growth is pretty stagnant right now. So unless it's something where you can find, like the United States is using a lot of this, then I would stay away from it. What I would want to find, I guess if you're if you're looking for a silver lining in basic materials, find something that's closely tied to the U.S. housing market, because home building is still going up, or it's still growing. So if you're in basic materials, it doesn't mean it's a lost cause and, you know, don't present anything, but it's going to be more challenging for you at this point in the economy.
Okay. Any other questions for him? All right. Thank you, Donnie.
Sorry that took so long. Anyway, hope you got a lot out of it.
Yeah. Shortest presentation ever. Evan's going to come up, and once again, we'll give him, he's going to do his spill for half hour or so, and we'll see what he gets through, and then Donnie will have some breakout questions, and like I said, we'll still end it too. Sorry, Michael will have some breakout questions. So, thanks again, Donnie.
All righty. Get the clicker. All right. Well, I'm Evan Jones, current VP of Risk Management. I'm an accounting finance major. So my object is to use my sweet Southern accent to charm you about accounting here and financial statements. So we'll just start off. Who's had some accounting classes by raise of hands? Okay, more than I thought. That's good. So we'll go through fast the accounting basics, and then I want to get more too on the financial statement and how to kind of go over an annual report of a company. So here's the just basic accounting equation. You've got your assets equals liabilities plus owner's equity. So your assets, you know, is what the company owns. It's what they possess, their resources, what they use to, you know, expand their company. Whereas liabilities are what they owe. You can see a little example of writing a check, paying on account, your accounts payable, so to speak. And then your owner's equity, which is what the owners invest into the company to get it going. You can see it's got subdivisions here of capital, drawings, revenues, and expenses that make up owner's equity. And so investments is what you can see here is the owner uses these assets to put into the business. And then the drawings takes out, and then the revenues, which is a key focus, and we'll get to on the income statement. Like I said, I'm going to go through this part fast since we're on a rush for time and get to the statement review. So those four, you've got your investments by your owner, and your revenues increase the owner's equity, and then your expenses and withdrawals from owner's equity, obviously they decrease it. So why would we analyze these financial statements? So first of all, you know, we want to know the performance of the company, see how it's growing there. And, excuse me. And then secondly, you'll hear this term expressed in accounting a lot as going concern. So if the company is performing well, how are they going to continually keep performing? What's the trends, as Yelena mentioned earlier, that's going to keep them going in the long term? That's really what we want to look at. And an example is, so like we're invested in Facebook, and back when we were initially doing our review and deciding which stocks to put in our portfolio, we were reviewing Facebook versus like a newer social media as in Twitter. So kind of Facebook, had that longer term approach that you could see that they're going to be sustainable over a longer period of time, where Twitter's kind of hit and miss. So we decided to go with Facebook. And then another important reason, especially as VP of Risk Management, is to help identify risks that we determine is called red flags. You'll hear us say, watch out for this red flag. And we do have a list of those that hopefully you will get here in the near future. So here's how the financial reporting is kind of set up. You have the financial statement preparers, which would be like a public traded company. So obviously we're in 100% equity fund. So we're all stocks that are publicly traded. So their company, so let's say for Facebook, they have their internal accounting department that produces their financial statements. Then you have the external accounting. So an example like Ernst & Young, EY, a big four accounting firm, does the external reporting auditing, and that's created to make them more transparent so that we as the investors can understand how the company is developing and what's going on inside the company. And then there's just the basic accounting framework. You have your business transactions, such as your sales, your purchases, expenses, and then the big thing in accounting is obviously the journal entries, the processing. We put those in a specific period of time to help combine into the financial statements later on. So GAAP, that's one thing, especially when I first started out as a freshman, I heard this GAAP and I'm like, what does this have to do? We're not talking about clothing. I don't shop at Gap. But this generally accepted accounting principles are the rules that govern accounting and reporting. Accounting is very rule-based. As you can see, especially with all the financial turmoil that we've had in the past decade with the financial crisis, housing market, and you'll hear a lot in accounting, I'm sure the Enron and the fraud behind everything. It's a very ethical, moral-based profession that's taught to govern these financial statements. So let's see here. So that, and then obviously we'll keep going, and there's a red flag if the company doesn't follow GAAP, which all publicly traded companies do have to follow GAAP, so that's not one we'll have to worry about as much in the field, but eventually as you go into this career path, you will be watching that. So some accounting basis, you've got your cash basis, tax basis, accrual basis, and as you can see, cash, you're recognizing it when the cash is coming in and going out. But required by GAAP, you can see is accrual basis. You can't recognize your revenue until it's realized, collectible, and earned, and you've completed the task. You've completed the service that you've sold. So that can be, very hard. Accounting's a lot of estimates. You kind of have to estimate that at times. So another red flag would be if the company is not using accrual accounting. So the valuations based on our GAAP are historical cost, which is the primarily one used right now in accounting. But for us, our sake is fair value, which is obviously referred to as mainly a market value or current market value, and that's used to analyze securities such as the stocks and bonds that we're doing. And as you can see, but GAAP is moving more toward this basis of valuation, which will be a key aspect. I would kind of put a star by that GAAP is moving toward this basis of valuation. If they end up changing that and going to that, it'll make it a lot more relevant. But the main reason we're using historical cost is because it is more accurate as price is, volatile, going up and down. And there's some of the other valuation methods used. So some assumptions here in financial reporting. You've got monetary unit, which the main thing is this is how we report the transactions. And as you'll see on the financial statements, the sales, the property, plant, and equipment, it's not by the number of equipment you have, but it's expressed in a dollar figure. So in our case, the U.S. dollar. Economic entity, the main thing here is you have to use what's related to the business. You can't put in the past, before these rules have came in, a lot of owners and companies were putting personal items on their statements and stuff for tax benefits. And then the time period, all these statements are mainly in quarters or annual, yearly time periods. And then again, that going concern. So here's the basic accounting principles. You've got revenue recognition that we've hit on. Matching, you have to match them again based on that basic equation, assets equals liabilities plus owner's equity. They have to be equal. If not, something's off and you have to go back and make your changes. And then again with cost, you can't, right now the GAAP uses the basis of historical cost to report because prices are ever changing. But this will be something to watch going forward, is hopefully they'll choose to go to market value. All right. Let's see. Slow down a little bit as we get into these. So the thing you'll hear a lot again in accounting is materiality and conservatism. Materiality is mainly put in place to understand the difference in meeting or not meeting analyst expectations. This can obviously be manipulated a lot. So only items that impact the company's overall financial condition gets put on the financial statements. Like you can see, problem, the kind of red flag there is that small items a lot of the times can be the difference in meeting or not meeting these analyst expectations, which, you have I guess quarterly estimates that come out for a company. Like we'll be speaking about Verizon, and this will be the annual report we review here in a little bit. But their expectations came out actually yesterday afternoon, and they beat all the analyst expectations, which is in return, moved their market value up. Their share price has gone up, I think, over 6% the past 2 days. So that has a lot to do with materiality. And then conservatism, it's kind of the accounting. We'd rather slightly understate the the balance sheet, the net income, instead of overstate. So a lot of times this problem may not be the best to reflect the transactions, and net income can be understated instead of overstated. Break this down. All right, so you have your annual report, often referred to as a 10K of a company. It's the company report explaining their financial position a lot, with the financial statements in them, as we're about to get into. But this is broken down, and we'll be going through an example here shortly about this. But it starts out with the letters from management, and then management's DNA discussion, MD&A, kind of discussing the previous year, quarter by quarter, how the company's grown and done. Then you'll have the main financial statements, your balance sheet, income statement, statement of cash flows broken down. And then a key aspect that we like to look into in from an annual report is the notes to the financial statements. It kind of breaks down what's going on, instead of putting into words, explaining what those numbers kind of mean, and how they're, what estimates they use to derive those numbers, and so to speak.
And this is what he's talking about with the 10K. So when he goes over 10K, he's basically giving you like a table of contents outline here. So this is kind of important here. I mean, up to this point, he was just going over some vocabulary terms that you may come up upon. Here it is going to be really important, because you're going to want to know where to find the information you need for your company in the 10K.
So definitely, you can just put a star by this slide here. And then one more thing again about that external accounting is you have the auditor, and they give their opinion on the financial statements. The company, like I said, the internal accounting department of the company produces the statement. Then the external accounting, the auditor, kind of reviews it and puts their opinion on it. And if you see, obviously we have a red flag. If they put anything other than unqualified opinion on the statement, that's a red flag, which it's kind of confusing there. Unqualified means that the financial statements are fairly stated and everything is according to GAAP and the rule-based accounting. So you definitely want to make sure that they're, according to their external auditor, they have unqualified opinion. All right. So I'll slow down here as we get into the main financial statements. You have your balance sheet, your income statement, and your statement of cash flows, and your statement of stockholders' equity. Of these three, the balance sheet is again kind of the basic equation. It's got your assets, liabilities, and stockholders' equity kind of broken down for the overall view of the financial position of the company. Where income, as you'll see, is just bottom line net income. Did they make profit or did they lose money on the year? So the balance sheet, okay, also you can see the other names that might be referred to, but it's a point in time. They'll also produce, there's 4 quarters in a year, obviously. So you'll have each a quarter report, each quarter explaining how the company's done, and then the overall year approach. And then again, as we've kind of hit on those. All right, so this will be what's reported under assets. You have your current assets, which is like your cash, accounts receivable, what you're kind of owed from your sales, inventory, supplies, everything that's kind of short term. Then you have your PP&E, you'll hear a lot, term property, plant, and equipment. This is a big thing to kind of analyze to see, what property they own, how are they expanding from that aspect. And then you'll see other assets. If the company has a large other assets, this is a lot of time they can kind of hide away money or hide away assets in here. So if they have large other assets, that's a red flag to look at and kind of see, in the notes to the financial statements, maybe what's reported in there.
Go back real quick.
All right.
couple of things to remember here. This goes back to that oldest accounting equation in the world, that assets equals debt plus equity. If you see assets are on the left-hand side, they're going to have to add up to what that debt and equity is on the other side, okay? And that debt is pretty much what it is. So when those assets go change in value of any kind, if you add assets, whatever, that's probably going to get changed with owner's equity on the other side, okay? The way they're listed is based off of liquidity. So if you look at current assets, what's the most current assets you got? Cash, right? And then you're going to go receivables, inventories, you're probably one of your least liquid current assets. And then you get your plant, property, equipment, intangible assets, things like copyrights, stuff of that nature, right? Stuff you can't really touch, like Nike swoosh, right? Something like that. And then over there you got debt, same thing with debt. Debt's going to be listed. Current liabilities have to be paid off usually within a year, okay? And then you got your long-term debt. Debt is going to be a big thing for you guys, okay? If you look at a company and you see what its debt to equity ratio is, how much debt it has versus equity, it's, you know, you're going to want to compare this to competitors. You're also going to want to see if it's getting worse over time or whatnot. But a lot of times it can be as simple as if they got more debt than they got equity, you might want to walk away. Okay.
Yeah, exactly, and that's what I was going to get is when we wrap this up, you know, a lot of these ratios we've been throwing out to you are derived from the financial statements. That's where these numbers will come from. And then there's kind of a quick example of a balance sheet. As you can see here, the total assets equal the owner equity, or total liabilities and owner equity there. And most of these financial statements, as we'll show in the Verizon 10K, is they're usually compared to year-over-year review. There'll be 3 to 5 year kind of growth of the company. Then we get to the income statement. It's definitely the most well-known, as the media kind of speaks about this a lot. You know, net income, profit, sales. It's your revenues minus expenses, so it's breaking down that owner's equity from a revenue and expense report. And obviously, if the revenues are greater than expenses, you'll have net income, net gain on the year, and if expenses are greater than revenues, a net loss. So every now and then you'll see a company, you know, it's not necessarily a red flag for 1 year if they have a net loss, but if you see 2, 3, 4 years recurring net losses, that's obviously a red flag and something we would want to invest our money in. So items on the income statement is kind of breaking it up. You have your revenues and your expenses. You've got your operating and non-operating expenses. So you don't want too many non-operating items on there. So you want money to be used if you're having too much interest, paying out too many taxes and charges on different things. Can obviously be a red flag on the income statement. And here's a view, just kind of your basic breakdown. You've got your net sales, what you sold during the year, and then the cost of what these items cost to make minus depreciation kind of gives you your earning before interest and taxes, and then derive at this bottom line figure here, net income.
Well, Evan, what can you infer from a company by looking at what they do with their net income? Meaning, like, how much goes to dividends versus retained earnings? What does that mean?
Well, dividends is kind of what's paid out to stockholders,
Right.
equity holders. So obviously you want that number to be a little higher. In addition to retained earnings is what the company retains, and then they kind of can choose what to do with that money. A lot of companies you want to see too, especially growth companies, you want to see them reinvesting it in the company to continually grow that one year over year.
Right, so he's absolutely right. So if a company's paying really high dividends, meaning most of that net income is going back to the owners in the form of dividends, that's a value company, right? And if that company is keeping most of its money, plowing it back into the company, that's a growth company because they believe they can do more with your money than you can, right? So a lot of times just by looking at the dividend payout ratio or the percentage of dividends, percentage of net income that's going out as dividends, you can see real quickly, are we talking about a value company or we're talking about a growth company, right? And that's important because how you analyze companies a lot of times gets back to these PE ratios, stuff like that. You need to know in your mind what kind of company am I dealing with, right?
Exactly. So like, a utility sector company will typically have the higher dividend payout ratios as their value-based sector. And then, a growth company like IT and Apple, Facebook, you won't want to see them with a high dividend yield. You'd rather see them reinvesting that money
Right.
and their innovation team and coming up with new products.
Yeah, go ahead.
Does the Smile Fund tend to favor stocks that are dividend yielding?
Not a whole lot. I mean, you can see that is an approach we have in our contingency plan. You know, if the market continues to devalue, we'd like to move to some more value-based stocks like consumer staples and utilities that are more value-based. But as far as we're mainly looking for that large cap growth is what the majority of our
We have a blended strategy. I mean, we really do. I mean, I like this. We probably favor growth, but I mean, a lot of it depends on what the economy is doing too. So we're not going to go. We're going to keep ourselves flexible. So we're not going to go. It's a great question, Drake. We're not going to go die hard growth if we think there's a recession right around the corner, because we're just going to get burned, right? At the same time, as long as we think we got a good company, y'all are young. You're willing to take the risk, right? So you don't want to be in all dividend stocks either, right? So, we're going to have some utility stocks, and we're probably going to be value based there. We may go for some growth plays there. It all depends on what it is, but that's really where it comes back to talking to Perry or talking to Donnie and trying to figure out what's our best move at the moment. Do we want to be more of a growth fund? Do we want to be more of a value fund? And that's why it's really, really, really important that before you go and spend 100 hours analyzing a company or whatever it is that you decide to do, that you throw that idea at Perry or Donnie and see what they say, because they may say, yeah, that's a good company to invest, but we probably won't be able to really consider it until the economy changes, right? So make sure.
And one thing I had highlighted, I did want to go back and mention, if you want to underline depreciation or put a star by it, I was going to use this example. I recently did like a job shadow with a hedge fund manager, and he was just talking about depreciation. You've got your straight line depreciation versus your accelerated depreciation. Straight line's kind of year over year, it's the same amount they're depreciating on their asset, whatever it may be, for a car company, their vehicles or something. The example he gave me, which if you're 90 babies like me, you right remember a movie gallery, the DVD renter when we used to have to rent them. He was analyzing them. He worked at Morgan King investment firm, and was saying that the DVDs were being at a straight line depreciation method, kind of the same amount. Which he's like, well, that should be a red flag. That doesn't really make sense. He's like, DVDs, new releases, they're obviously going to get used more up in the beginning. They're released, so that should be an accelerated depreciation, where it's depreciation high at the end and then lower, in the back end. So he was like assuming that GAP was eventually going to change a rule on this, and that he was kind of wanting to sell and get rid of it. But Morgan Keegan was a customer with the movie gallery, so they brought him in, but and he ended up being right, and setting them down. And GAP did make that rule change to where they had to use accelerated depreciation for the DVDs, ultimately kind of killing movie gallery and tanking that industry. So that's another thing we want to look in, as far as these trends. Does the company make a product that's going to be, that a rule can come in that might change it and devalue that company going forward? So just looking for something that technology won't be able to produce as easily, so to speak. If that makes sense.
Yeah, so what he's talking about there is sometimes they call that a competitive advantage. I've also heard the word moat. So you want companies that, if you think about from a SWOT analysis, have more strengths, less weaknesses, are not worried about threats, have lots of opportunities, whatever. But they sometimes call it a moat, meaning that you can build a moat around this company to protect it. Nobody can touch it. Nobody can do what it does the same way that it does it, right? And so if they've got that competitive advantage moving forward, then that's a pretty safe bet, right? And so, you can look at, sometimes that'll happen really easily with a pharmaceutical company if they've got a lot of patents that protect them for a long time moving forward. Or you've got, Starbucks, for example, has like a reputational moat. Is Starbucks coffee that much better than McDonald's? Probably not. But are people willing to pay a whole lot more for it? Yeah, because they've built a very strong reputation. So if there's anything that you got that gives you like this competitive advantage, you could call it a moat, so to speak, moving forward.
So then lastly, we'll have the statement of cash flows, which is arguably the most important. It doesn't get a lot of attention by the media as much, but it's definitely one of the more important statements. So you can see it's the sources and uses of cash, how the company is using and spending their money. And I would circle operating activities, as Michael was pointing to earlier. This is a key, screening technique. We want to see the day-to-day operations, how they're making and using their assets. And then you've got it's broken down into operating, investing, and financing. But as you can see here, the operating is kind of more business-driven, shows what is sustainable over a longer period of term, whereas the investing and financing section of the cash flows is kind of management-driven and can be kind of manipulated a little bit more by the management. So, there we go. So business-driven, and then operating negative. If they have negative cash flows over a period of time, that's a red flag. We want to have a very high-end operating activity section in the positive range. And then the one thing I was going to do some blackboard stuff on, but that we may save for Tuesday, is kind of using that CapEx to determine the growth and what the difference between manufactured growth versus sustainable growth.
Yeah. I can't stress enough that red flag. Okay, that's a really good point that Evan's trying to make there for you guys. It's not always obvious, but when you take an accounting class or finance class, they love to spend time on the balance sheet or the income statement. But the better analysts, you'll hear this from folks like Ray Ryan or whatnot, really know how to pick apart the statement of cash flows, because it's the cash flow that's harder to manipulate. And so a company with positive operating cash flow is really telling you that that company does something good, right? But you can get to where you can like manipulate net income depending on how you're using interest. Right? For example, one of the main ways we're manufacturing earnings right now is interest rates are at all-time lows, right? So are these companies going and taking out a whole lot of debt at a low interest rate, taking that money and then buying back company stocks? Now, when they buy that back, they're deleting the number of shares outstanding, right? So what do you think is happening to their earnings per share? They're going way up, right? Their earnings don't even have to change. They could have flat earnings, but their earnings per share could be going way up because there are now a whole lot less stocks, shares out on the market. Does that make sense? Now, that's not necessarily a company that's getting better. That's a company that's manufacturing earnings per share. Make sense?
Is there a reason that they would do that other than to manufacture?
Yeah, sometimes if you do it slow enough, people aren't paying attention to it. It is a way to kind of falsely make that company look like it's doing a really good job. So is there a little bit of an unethical spot to it? Yes. Is there an ethical spot to it? Sure. Well, you could say we're doing what's in the best interest of the company right now because debt's cheap. And especially if you can say our stock price is at a really low price right now, it makes a lot of sense for us to. We believe the company's worth a lot more than this, so we're going to buy up a whole lot of our stock right now using cheap debt. So yeah, you can make the argument for it, but it's also gonna fudge other numbers.
I saw that when I was in Sherwood. I saw that
Yeah.
they were buying back stock and buying back stock.
Yeah, and there's a lot of companies that are doing it. I'm not saying they're all trying to like manipulate the numbers, so to speak. I'm saying you have to look and see if the numbers are being manipulated. It's not like they may be doing it ethically, but you need to know whether or not that's why those earnings per shares are changing, right?
Which he just basically did the wrap-up for me there on that wrap-up slide, but kind of what financial statements should get the most attention. Don't always do, like kind of overkill by the media on the income statement. But we do, the best analysts on Wall Street tend to look at the statement of cash flows, so that'll get you way ahead of the game if you start to dive in that and understand the operations of the company more so than the income statement. Is there any questions before we move on to reviewing the annual report? All right, well, that's good enough. So we'll kind of review. As you can see, it says one of 80 pages at the top. I don't expect anybody to go through and read all 80 pages of any annual report. So my job is to kind of help us narrow down this information and know what to look for. Like I said, it starts out here. You can see this is some kind of company highlights showing you what they did good that year. And then it'll break down kind of the CEO will go through. That's another thing that came through the Enron and accounting cases, the Sarbanes-Oxley, which is a part of the movement going forward to make the company more transparent and more ethical standard. The kind of CEO gives basically his thoughts on the company and signs off on the annual report, saying so that he's responsible for what happens and what information is produced to the investors. But I have some things highlighted here. We'll go. And then first of all, I guess, yeah, I mean, obviously everybody knows Verizon. How many, by raise of hands, uses Verizon Wireless as their server? It's one of, the top ones. Competing them, and again, it's another one where we compared them with AT&T and chose to go with Verizon for the long run. Kind of break down, but it's not just Verizon Wireless. We'll scroll through here, get down past this corporate highlights, and more to the MD&A. It kind of gives the company overview. If you don't want to, you can kind of see the overview, and it's found. You can see here the business overview. Tells you the segments of the company. That's a big thing. Going into next week, Yelena will be kind of talking about the price model and how to analyze the company from that aspect. And we want to break down the segments and where the money's coming from. And so, for example, Verizon, everybody knows Verizon Wireless, they're focused on their 4G LTE smartphones and tablets, selling those from a retail aspect. But they have a second segment that doesn't get as much attention as wireline here that we have highlighted. And you can kind of see showing so that one decreased in the past year. This is a 2014 annual report, their most recent one. But they have this, which I didn't know until reading the annual report, this time last year when we were reviewing it, FIOS, which is their kind of TV and broadband service that they're coming up with. I think I've looked, it's sixth in paid TV subscribers in the U.S., behind the big ones. So that's something to look at going forward. Is that growing or declining? Which the annual report here kind of tells us. So you can see there it represented 76% of consumer retail for Verizon during the year. And then this is just all MD&A kind of discussion, the condition of the company and results of operations. Then it compares year to year, kind of compares quarter to quarter, in here. Have the pages. So there you go, segment results of operations. This will be a key one that you'll get a lot of your information from as you're producing these price models going forward, that you'll learn a lot about coming, which I don't expect you to know too much about right now. And it breaks it down. There's the wireless section, kind of the numbers. This breaks up, the financial statements are all down here a little bit lower, but this kind of breaks them up, makes them easier to see in a segment view. And there's the next one, the wireline segment, as you can see. And we'll get to page, I think it's down in page 40 is where the kind of skim through a lot of this. A lot of this, I don't expect you to read all of it. But again, here, all right, here's the cash flows used in operating activities. As we begin highlight, and I highlighted this, and we'll go over maybe next week sometime. Is capital expenditures. CapEx is a big term that we'll use to derive some information from. And you can see here, this number here, 17,191, and then you divide that by your depreciation to get kind of see what's sustainable from a growth aspect. And then they went ahead and broke some stuff down there for you as a percentage of the revenue. All right. And then, all right, from a risk management, this is the main thing I'm wanting to show. The 10K kind of shows their market risk. As you can see, they're exposed to interest rate changes, foreign currency exchange rate, changes in investment, equity, commodity prices, and tax rates. So as right now, like this year, we know that commodities have been hit hard and that interest rates are expected to gradually increase this year in 2016. So that's something to kind of look at and watch and see read deeper into here to how it might affect the company and how they're hedged against those risks. And again, all annual reports will have this. It's not just for Verizon, all companies.
Yeah, it's really interesting when you dig down into some of these companies. You have to see if they're hedging, because if they're doing anything within that company, then that can change whether or not you want to invest in that company, because they may be hedging in a way we're already hedging somewhere else in the fund, and maybe we don't want to hedge too much that way, or maybe we like that because they're in agreement with what we're already doing and that kind of stuff. So sometimes you want to look and see if they're doing any kind of derivatives. Sometimes a lot of companies will do some hedging stuff on the side, especially when you get in the area of like agriculture, or if you get in the area of energy. Those are two areas where you could see significant derivative products within a company.
And here's another one. This is kind of, again, where I talked about that external auditing firm, Ernst & Young, E&Y, does Verizon's, and you can see their report is dated and they expressed an unqualified opinion. So that's a good thing. They're happy with the regulations following to GAAP and their statements there. So again, kind of this date, so you can expect towards the end of next month, beginning of April or beginning of March, so to speak, you should be seeing Verizon's 2015 annual report. So that'll be a good one for us to review again then and see how they've done this past year. All right, so and then finally, after that, and then the auditing opinion, you'll get to the financial statements. And first, you'll have the statement of income, again, because it's the most popular. They try to get that into you first, kind of broken down, their revenues and their expenses there. And then again, here's their earnings per share versus a diluted earnings per share, which it's good to see that they're about the same. A diluted earnings per share kind of, I don't know, is the more account, I don't know to explain that. Can you, the diluted versus the typical basic earnings per share?
Let's see.
Diluted means there's options on the stock, there's bonds that could be converted to stock. There's a lot of what ifs in the company, like what if everyone wants a piece of our stock right now, and that kind of devalues the share that you currently hold. And so basically they're saying if everyone decided to convert their options or bonds or whatever to our stock, this is how much earnings per share you would have if that happened.
Yeah.
That's a good.
A lot of executive compensation includes options on stocks, so that's a huge chunk of this.
So there you go. And that's a red flag if they're, you don't want a dramatic difference between the basic and diluted earnings per share there.
You always include.
Then you've got your balance sheet breaking down their assets. And then these intangible assets kind of, let's see. And you don't see too many other assets. It's relatively small again, so you don't have to be too worried about that. Liabilities, equity. And then the statement of cash flows, which is huge here, is again the cash flows from operating activities. You can see and derive the numbers again. This is where you'll go to get a bunch of those numbers to do your own computing of the financial ratios as you become more enhanced in your when you're analyzing these companies and proving that the numbers, you don't want to take verbatim that the numbers are correct off top from a Yahoo Finance or anything. You want to kind of prove that you've got the same range by using these numbers. So there's that. And then the last thing I wanted to show, scroll down, kind of skip, and then you've got the notes to financial statements, which again kind of puts in words and helps you understand these numbers better and kind of understand what approach they used and how they recorded their revenue and what estimates they used. And then it's kind of talking again about the two reportable segments and breaking them down in the notes to financials. And let's see, towards the bottom, from a risk aspect, one thing I like for us to look at is it's usually something under commitments and contingencies or litigation, something like that. which it should be, I think, page 76 down here. I have to highlight, yeah. You always want to highlight this section and read, because they're required by the rules, again, according to GAAP, if it's reasonable and probable to happen going forward, they have to list a reasonable estimate of contingencies, which is lawsuits that they might have against them. And obviously, a bunch of companies, these large cap companies are going to have multiple, suits out against them. But typically, it's not anything that's big enough to hurt them overall. But one thing here we highlighted that they have broken down is this settlement from 2012 that's going to be paid out of $0.4 billion for each year till then, and then the following 6 years. Another thing I wanted to bring up, I know Verizon and ESPN were involved in a lawsuit earlier this year. ESPN was suing them, and because their FiOS package, Verizon, was breaching the contract they had with ESPN over the packages that they had of their ESPN channels giving out. So it'll be interesting. They hadn't thrown a number on that yet of what the possible outcome could be. So maybe in the 2015 annual report, that'll be something to look at to see kind of what their reasonable estimate of that is going forward.
Well, we don't care, right? We own Verizon and
Yeah,
Disney,
so,
right?
either way.
Either way, we're fine.
But that's pretty much what I wanted to cover there, and then the rest, is just not much. But
So,
out of the 80-page document, you're going to probably review about 10 of them.
yeah, and you got to think too, like this is an annual report, that a 10K for a company, like as Yelena just pointed out to me, that this was the annual report, not the 10K. 10K is could be several hundred more pages, right? Like 300 pages, something like that, right? So, Evan's job is a little different than y'all's job. Evan's a red flags man. So Evan goes through there and he's looking for particular red flags that he always kind of looks for. It's kind of like a checks and balances system. But you should be looking for them too, okay? So he's just giving you a little bit of information, trying to get you not scared. I mean, if you've never heard of a balance sheet or an income statement, all we're trying to do here is give you a little bit of exposure therapy, okay? It can be a daunting task, but it's one of those things you see it a little bit and then it starts to make sense. Over time, especially if you help somebody write a report and everything, let it build slowly, okay? And you'll start to see which numbers matter, and it's all different for different industries. In some industries, some things don't matter at all. In some, they matter quite a bit, okay? So I thought he did a pretty good job of giving you some terms out there and showing you some of the financial statements. And hopefully you won't be as scared to take a look at it when you actually see it. All right. Thank you very much, Evan.
Thank you.
I'm not really here to teach you guys anything like everyone else has so far. Hopefully you've learned something. But I was here to kind of do like a brainstorm session. It's something that we'll want to do on a more continuing basis, so this is probably not going to be the first, or it won't be, it's the first, but it's probably not going to be the last one that we're going to do. And since we only have 15 minutes, we won't get through all these, so does someone want to pick a question and we can talk about that question for the next 15 minutes?
Whatever questions.
Everyone should have slides, so there's what do you think the essential commodity will be? Pretty,
Let's do the big tech one.
Alright, so I've sent out these questions last night, but why don't you guys, I'm going to start Reef polling, so if you pull it up on your phones, your laptops or whatever, you can submit answers and then we can look at them. So it'll everyone can kind of see what everyone else has to say. I'll pull those up in a minute, but we'll talk about it. So just take a minute and think about your answer and what we could talk about. And we'll probably start once we get a few answers. While you guys are typing up your answers, I'll point out a couple cool things. So we use this a lot for voting. So we'll have a screen up and it says, should we buy Microsoft, and then I'll have yes, no, or decline to vote or whatever, and we'll have a multiple choice then. But we can see exactly who has voted or responded, so we can kind of see if we should wait any longer or whatnot. And then we can also see the results at the end or even live. So I'll go ahead and pull up, since we have 8 responses, we can go ahead and start the discussion. But this is kind of what people have already said. And if someone happened to say the exact same thing, it would say like 2 votes. But so we see driverless cars, battery storage. I guess we see driverless cars a couple times. Holographs, virtual reality. So how do you guys think this will affect the world as we know it right now? Let's take self-driving cars, for example. What would that mean for the economy?
Decrease transaction, or like decrease like trucking expenses, remove materials. You have driverless trucks.
Yeah, and there's not really any wrong answers. Like, I don't know the answer to any of these, so this is all speculative. This is where we're going to get our ideas from the fund, because we want to beat the market. So that means we need to know something before the market does. So even Ray has said that since we're pretty young, we have a good handle of like what's up and coming. So the more ideas we're able to exchange, and that's why we'll have more of these, the better chance we have of knowing where to go to do our research. So this is why we're going to be talking about this. So what, someone else said something, what was that?
I just said less accidents.
Lot fewer accidents, okay.
When you say about self-driving cars, is there really no driving?
Yeah, so theoretically, we wouldn't be driving.
So like trucking company or like that, wouldn't it increase the
Okay, yeah, that would increase unemployment for who though?
Truck drivers.
Truck drivers, yeah.
Yeah, like who has a big truck driving expense? Walmart, JB Hunt, somebody like that? I mean, or JB Hunt, is JB Hunt the transportation arm? Or do they,
I don't know.
so like Tyson Chicken, somebody like that, somebody that's like delivering products all over? I mean, they may be able to make a killing if these things can come on the market and they're not paying truck drivers, or these truck drivers aren't having, truck drivers fall asleep and have wrecks, right? So,
I think you could be investing in something along the lines of logistics for companies that would be saving a lot of money.
right, yeah, so there'll be some logistics companies, obviously, that, so this is probably out in Silicon Valley somewhere, right? They're probably gonna make a lot of money off of it.
Yeah, so now let's start moving to that. Where would we look to invest in an autonomous driving transportation economy?
Right, Tesla. Right. Should we look at a trucking company? Anyone think that's a good idea?
I'll probably go to a company like Uber or Lyft before,
What's the difference? What's the difference between an Uber and a trucking company?
I just think that it's more accessible to the public. They're growing right now, and it's a big deal. And I think two of the issues with grows in the companies, like assault by the drivers and things like that, would be eliminated. So I think it would increase.
I didn't think about it till just now, but I find it really interesting that no one put drones up there, which would be huge competition against driverless truck driving, because then there wouldn't have to be like road conditions, or it's all in the sky. So it's a more direct route anyway.
What's the difference between a driverless car or truck and a drone? I mean, one's in the air and one's on the road?
Well, one
you could
has
say
to
that.
abide by the rules of the road.
You have
where the
to
other
abide
one-
by the rules of the air.
True, like aviation.
Because
but-
there's still like FedEx.
They're an aviation company, so and airplanes are more autonomous than cars are right now. You almost don't really need a pilot; they're just kind of there for fallback. One thing I've thought of is, I mean, we mentioned like Walmart Well, now they don't have to pay all their trucking costs, so that will reduce their expenses. I said invest in a trucking company. Well, if they're still trucking, there's still that need for ground transport, but now they don't have to pay all the drivers. That's even lower. Their expenses are even lower now.
Those truck like costs higher initially, right?
Initially, yeah.
It'll be a huge initial investment, but they won't have to continue to pay benefits, wages. Should be fewer accidents.
Would like FedEx and UPS go completely this route? I mean, would you like, they like show up and like drop a gift and drive off? I mean, if that's the case, you could have those suckers going like 24/7, right? So that'd be nice.
I think it also depends on how they pay their drivers. Like if the drivers are contractors who have to carry their own insurance, then that would be more liability that the trucking company was taking on. Like I was just saying, like Uber doesn't want to own cars, so I don't think. They also, like, if there's no driver in the car, then people are going to start doing gross or illegal things in the car sometimes. So I think that would kind of hurt their.
There aren't people camera them
Maybe yellow
They camera. Some people aren't.
Some people don't carry the taxi drivers.
Spotlight.
I feel like we're talking about a lot of tangibles, like will it be a driver, will it not be a driver, will it be a drone, will it be a driver in this car. I think it's nice to focus. Now I'm on basic materials, so I'm biased, but I think it's easy to focus on maybe some of the components that go into all this stuff. Because no matter if it's a drone or has a driver or not, it's going to need a new computer system. All these new cars are, and computer systems require a lot of palladium. It's using a lot of electrical components and things like that. So we could possibly look into maybe some palladium producing companies or silicone producing companies or boron, things like that. I don't think computers are going anywhere anytime soon. I think we could all agree on that just about.
Still seeing increase in that. There's a company called Mobileye. They are the ones that make chips that basically you can put like in the camera of your car, and they'll determine if it's like a stop sign coming up, where the lines are on the road, and like they autonomize all this stuff. So they're the ones that Tesla buys from to get the software basically. And then someone has to make the cameras and radar and all this other technology too. So that's what you also have to start looking at. So Tesla might be, someone said Tesla, I can't remember who, but Tesla might be one of those companies right now that's starting to move toward autonomy, but they have to get they're not doing it all themselves. So where are they getting their stuff from? So those are other places we should look. Anything else anyone can think of? What does that mean for traditional cars? Are people going to own cars anymore?
I would be I don't know. I don't even like the idea of Uber. Like, I wouldn't want someone else driving me somewhere just because that makes me uncomfortable. So, like, as far as how consumers look at it, I think it would take a long time to catch. I mean, I don't like to follow Google Maps, let alone let them drive me around. Like, I just don't want to. So I think it would take a while to catch on in general. And I think people still own cars too.
What about in like 50, 60 years though?
Well, I mean, when you're born into it and then that's just normal to you, I think it'd be different. But like as of right now, or like when it came out rather. But I don't know if it would catch.
I do think you're talking about a major infrastructure change. This is not something we're going to invest in. You're going to see a big return while y'all are still in school. Okay. But yeah, how I think she raises a good point. What are the stages going to look like? Are the stages going to be something like at first, all you'll do is be able to like hit manual drive or overdrive or something like that while you're on the interstates, and and then while you're on the interstates, the car will drive itself or something like that. But then when you get off the interstates, it no longer has that function because there's too many variables at play or something like that. At what point does this happen? Yeah.
I think that's really interesting, and I'm curious to think that if people before us thought the same thing about cell phones. Like I'm not sure
Yeah.
like carrying a phone in my pocket. Like who does that? And then now everybody has it.
Yeah.
You know, I don't know. So.
That's interesting.
I was gonna say, they kind of have already started towards like the steps and everything, because they have cars that can park themselves, and like cruise control is kind of like, you don't have to press the pedals, but you do have to steer, but, so maybe they're kind of like slowly.
Yeah, and like on Google's campus and some of those, they have some self-driving cars that take you from one place to the other. So,
Tesla just came out with a new feature recently that's summon feature where the car will actually bring itself out of your carport or out of your garage and come to maybe your front door or something like that. So, I mean, I think the transition is definitely there.
I think they said within like 5 years they'll have like complete autonomy, and you can summon it from like New York to LA if you really wanted to. But like it almost drives itself right now as it is. So.
But I think that brings up another interesting topic because one of the things that are preventing them from doing this right now is, well, not necessarily Tesla, but because their engines are electric. But you obviously wouldn't be able to do this with the internal combustion engine. There'd be no way to fill it up. On the other hand, we could autonomize electric power for the vehicle. So I think this also brings us into the transition to electric energy rather than barrels of oil.
Right. And again, so that's another thing we would look at is like, how are we going to get that electric energy? What kind of people are going to provide that? Because those are going to benefit from this as well.
yeah, the energy shift, whatever that is and what it's going to look like down the road, is going to be huge. Virtual reality is going to be huge. I mean, I can see in the not too distant future, we could be having this, but every one of you could be in your bedroom and y'all could have just been like logged in, and you actually have a presence in a room like this through like a virtual reality system, or that I could be teaching anywhere via a hologram or something like that. Does that sound strange? Yeah, it might sound strange, but we're already you can kind of already do that on Second Life or some of those kind of video games. So why couldn't you just load up the Smile Fund as like almost like a virtual reality video game? You know, and we would meet in there, and then you guys, we wouldn't have to leave so early, right? We could chat all night long.
We can all get on Skype right now.
Right, you can all get on Skype right now. So I mean, this stuff is coming, and it's going to be weird to you guys, but trust me, a lot of things y'all do that's weird, it's like y'all do now that's normal, is super weird to your parents, right? So it's a matter of what it is, and you want to get ahead of the curve, right? And so we're going to have more and more of these brainstorming sessions like this, and I think we're actually doing a little bit more of this on Tuesday. Okay. Yeah. Anybody got anything they want to add to it? We can even keep talking about technology even on Tuesday. I just want to make sure everybody gets home safe for Snowmageddon. All right. Sounds good. Yeah, you can turn me in. You can turn in a